In this example, we'll look at what happens when a US-based company purchases an interest in another company that is located outside of the US, and how to bring those financial statements together to prepare consolidated financial statements at the end of the period. So you have a balance sheet here for Grant Management Consultants, January 1 of 2014 and December 31st of 2014 balances. These amounts are actually Swiss francs, right? So make sure you identify what currency the statements are presented in. And the income statement and retained earnings statement for the year ended is showing here as well. Right. Other pieces of information that we need are the exchange rates, $1.09, January 1, December 31st, $1.03. So the rate's gone down. The average, which we'll use for the income statement, is $1.06. And then dividend declaration and payments, we need the exact dates for those. So we're given $1.08. You're asked to translate the year-end balance sheet and income statement of the foreign subsidiary. So that's Grant Management Consultants, and then prepare a schedule to verify the translation adjustment. Right, so you need the income statement accounts here, and you can see that the revenues and expenses are translated using the $1.06, the average rate, right? Then net income is just the result, the difference between revenues and operating expenses. The beginning retained earnings, you'll use the historical rate, the rate as of the beginning of the year, which if you look back up to the chart is $1.09. And then the dividend here is translated using the rate in effect when the dividend was declared and paid, right? So translating the 40,000 of Swiss francs to retained earnings balance to US dollars, it would come out with 42.4. Then we're going to translate the balance sheet, and as you can probably see, because we're using different rates, we're going to have a difference, okay, and that's going to be the translation adjustment. So cash and receivables use the rate that is in effect at the end of the year. Same with accounts and notes payable. For common stock, you use the beginning of the period rate. There hasn't been any change in the common stock balance. So $1.09 is what we'll use to translate that. This 42.4 just comes down from up above. Okay, so you just drop that in. You have total assets of 94,760, total liabilities of equity of 97,160. So the balancing amount, the difference between the two, is the translation adjustment. Now, this is the first year, so you see cumulative translation adjustment, but we didn't own the company at the beginning of the year, so the 2,400 is the year, both the cumulative translation adjustment and the change for the year. Right. Then to prove that out, we take the what's called the exposed, in this case, net asset position. So if you think about what net assets are, okay, we can go back up here. The net assets at the beginning of the period would be the common stock and retained earnings. So assets minus liabilities, net assets, or 30,000. Okay. Start off with the 30,000, beginning of the period rate, 32.7. The changes in net assets in this instance were the net income and the dividends. Net income, we use the average rate. The dividends, we use the rate, the date of the dividend. All right, so when we translate those, we get a net asset position translated using the rate in effect of the times of these transactions. At the end of the period, the exposed net asset position, the net assets are 60,000. Go back up here again. 20 plus 40 is 60, or 92 minus 32 is 60, same difference. And if we take 60,000 and use the rate at 12/31/2014, we get 61.8. So 64.2 minus 61.8 gives us that $2,400 difference that we sort of plugged in up here, and now we've proven that it's the right number. For more information on translation and some of the theory behind what rates are used, go back and read a little bit more in chapter 12 in the textbook, but this should take you through the mechanics of this problem.